Getty Images, iStock photo. The Federal Reserve is getting tough. Not only did Chairman Jerome Powell's Fed raise interest rates by 1/4 percentage point Wednesday, but it also said there would be 2 more hikes this year instead of the 1 increase most people were expecting. The so-called Fed funds rate was immediately increased that 1/4 point to between 1.75% and 2%. Another rate hike is expected in September, and the 4th one of 2018 will probably come in December. I've already gone through this in previous columns. That 4th hike was still up in the air, but inflation has been getting worse and December has become a traditional time for the Fed to flex its muscle. On Wednesday, the Labor Department also announced that the Producer Price Index (PPI) for May rose 0.5%. The experts only expected a 0.3% PPI rise. The May increase was well above the 0.1% rise in April. Inflation on the producer level has now risen 3.1% in the last 12 months, which is also above estimates. Even if you don't count food and fuel, the increase in producer prices was 2.6% in the last year. But there's a question as to just how bad inflation really is. The PPI had gasoline prices up 9.8% in May. But the Consumer Price Index, which rose only 0.2% last month, had gasoline prices only 1.7% higher. One of those gasoline figures is obviously wrong. So either the PPI or the CPI is giving a misleading reading. The Fed's goal is to have the economy growing nicely, but with inflation only in the 2% annual area. If prices rise more than that, the Fed will be forced to boost borrowing costs even faster by raising rates. Fed boss Powell sounded optimistic about the economy at his press conference Wednesday. There's no law that says the Fed has to raise rates at 1/4 point intervals. Nor is there a rule that says rate hikes can't be announced between the official meetings of the Federal Open Market Committee, which concluded this month's session Wednesday. Nor is the Fed obligated to hike rates just because it has publicly said it will do so. The Fed will probably also get pressure from Congress to slow the rate hikes. The federal deficit widened by 23% in the first 8 months of the government's fiscal year, largely because of the tax cut instituted last December. And every time the Fed raises rates, it costs Washington, just like everyone else, more to borrow money and the deficit rises. Wall Street will be waiting to hear what the European Central Bank has to say after its meeting Thursday.